Hello everyone and welcome to the first video of Management Accounting, also known as MAF. As a first topic, we'll be talking about as a general introduction to Management Accounting. So what is Management Accounting? So generally when you go into the workplace, you may be in a financial accounting role. So a financial accounting role will be more to do with the preparation of financial statements, of monthly P&Ls, balance sheets, cash flow statements, etc. Another potential career path is auditing, and a third is management accounting. So what management accounting is it complements the financial accountants, and they focus on cost accounting, budgeting, and controls. So cost accounting is having a look at the costs, and it might be looking at more of an analytical perspective, whereas financial reporting is just reporting the numbers and that's it. Another thing that management accountants do is they budget, so they look forward and expect what the numbers are going to be in next year, the year after, and so forth, that the financial reporting team are going to produce. Now the reason that that separation is there is because it prevents any kind of consolidation of or cartel behavior, where the financial reporting team may try and pursue a certain agenda, etc. So by having that division of separation, there is a little bit more transparency, a little bit more control in the processes. So management accountants are very much aligned with the operations teams as opposed to finance and the decision makers within the organization. And the reason is it's very much about interpreting what the financial reporting team looking at trends and how does that translate into actual decisions. And again, there's that separation between the financial reporting team and the management accounting team. So in the CSG, there's this table which kind of outlines some of the differences between what a management accountant is and what a financial accountant is. So for example, the purpose of the information in management accounting is to help managers make decisions, whereas in financial accounting, it's communicating that. So really just putting the numbers together for them. And the users for management accounting are managers and decision makers, whereas financial accountants, the users are external users, such as investors, banks, who actually rely on that information. The focus and emphasis, so management accounting is looking forward, particularly for budgeting, etc. And financial accounting is more oriented towards the past. So, they're usually looking at last financial year's accounts, and they may not be ready for another 6 months or so until after the financial year's ended. So time span of reports. So management accounts, they'll look forward up to almost 20 years in some instances, but generally it's a longer time into the future. And whereas financial accounting is a fairly short period, so annual and half-yearly reports. And behavioral implications. So management accounting helps influence the behavior and the decisions of managers and other employees, whereas financial accountants tend to influence behavior primarily around remuneration and compensation, because that's the result that we're reporting to investors, etc. So management accounting has 5 key steps according to the CSG. So number 1 is understanding the information requirements of key stakeholders. Number 2 is gathering the information that's required to produce that report. Number 3 is analyzing, interpreting. So this is an important one, just because it's not just putting out data, it's analyzing, interpreting it. Number 4 is drawing conclusions based on that analysis. And number 5 is presenting information and making recommendations to management. So again, it's really just taking the information that the financial reporting team has produced, understanding what it really means, and then effectively communicating that back to management. So we then break up each of these 5 steps into a little bit more detail. So the first one's just understanding the business information requirements. So to be able to do that, you need to have a certain skill set which is slightly different to those in financial reporting. So you need to understand the organization, first of all. So what are the key drivers of the business? Is it revenue? Is it visits? Is it average revenue per visit? Is it a labor driven, or is it a what are the key drivers of the business and what makes a business successful? Number 2, you need good relationship with those decision makers and management. So if you're in financial reporting, it doesn't matter as much if you're a quiet non-talkative, not good with people person, because all you have to do is pull the numbers, check them, and consolidate them. Whereas for someone working in management accounting, you need to be able to influence decision makers. You need to be good at communicating it to them. Number 3 is an understanding of the different types of activities that management perform and the information required to support those activities. So obviously understanding those stakeholders, so not only just having that relationship, but really understanding who they are, what they do, why they would need what they do, and this all helps form part of that communication process. And the 4th part is knowing the right questions to ask in order to identify and clarify information needs. So it's not always clear to know what you need to be asking for or what you need to be doing. If you're in financial reporting, it's the same thing. It's just doing the same financial report over and over. Whereas management accounting, it's always a different problem, right? It could be a trend in sales, like why is our business declining? There's so many different possibilities there. You need to really think out loud and say, okay, where should I be looking first to try and figure out that trend? So that's understanding business information requirements. The second step, which links up here, is the gathering of information. So actually getting that data together. So a few of the considerations, and it's not that as simple as getting the report, because you need to make sure that the data is correct. You need to make sure that the data, we can actually obtain it. You've got to consider the systems and who knows how to use the systems and what export it can be, retrieved in. Number 2 is the data reliable? This is a really important one, because you can be given a set of numbers, but if you report numbers to management and it ends up being wrong, you're going to get in a lot of trouble. So you really need to vet that information. You need to look through it. Recently, there was an example of the Australian JobKeeper payment where the government put out an estimate that the scheme would cost something like $80 billion, and it ended up only costing about $40 billion because what happened in the data is there was an issue where businesses had imported, instead of the number of employees, they had put in their wage or some other data point, and because people hadn't gone through and scrubbed that data, they were actually working off the wrong data set, and that's obviously gotten the government and the analysts preparing it in a lot of trouble. So we've got to make sure that the data is reliable and correct. Number C, will it meet stakeholder requirements? So it's a common problem in terms of you send out an information request and the data you get back isn't what you asked for. So this is similar to that. The stakeholders may have a problem and we may give them a solution, but the stakeholder reads this and says, this doesn't solve my problem. So we've got to make sure that it does that. And you got to consider how you're going to get the information as well, so from internal sources and external sources. So internal might be IT systems, sales data, financial reports, business plans, etc., whereas external sources may be market and competitor analysis, political analysis, and so forth. So step 3 is analyzing, interpreting information. So this is, probably one of the biggest points. So now you've got that information, you know what you have to do. How do we actually get that data out and actually extrapolate what it's telling us? So we might need to look at trends, we might need to look at benchmarking, we might need to look at volume, cost volume profit, cost benefit, customer profitability, economic value added, net present value. So these are all the different kinds of metrics and analysis tools that we could use. It depends on what we're trying to achieve. For example, net present value, that's generally a means of valuing what a business is worth. So if we're looking to acquire a business, that might be an appropriate tool, but a cost volume profit may not be appropriate in that situation. So it's really understanding what are the available options and which one you should choose. Step 4 is drawing a conclusion. So it's one thing to see a trend in the data, and it's another thing to actually conclude from that data what the answer is. It really takes a very big and different and varied skill set to be able to pull all of these things together and come up with an answer that is actually correct. And finally, presenting information. So there's a quote by someone that the quality of the analysis is only as good as you've communicated. If you haven't communicated it well, it's as if your analysis has never been done. Look, so let's say you're the smartest guy in the world and you've done this amazing report. You've figured out what the problem is, you've got all the right data, you've analyzed it into a trend, and you understand what the problem is. But if you can't tell the CEO and the people who actually need to know so they can execute these decisions what the problem is, what they have to do, and how you got there, well, then there's pretty much no point you've even done all the points before that, because the whole purpose is that we solve this problem. And if he can't solve it, and if you haven't communicated to him how we can solve it, then we're in the same boat as if you hadn't done the analysis. So, the role that management accounting and treasury functions play within an organization. So a key division that management accountants often work in is called treasury. Now, treasury is a key function within the organization that has two main functions. So number one is advising management on the optimum capital structure based on the organization's objectives. So this will be looking at, what's our debt to equity ratio? Should we get more debt on our books? Should we issue a share raising so we have more equity? As you would have known from your other subjects, there's a number of benefits and number of downsides to having debt and equity on the books, as well as, what's your working capital in the business? So working capital is, how much funds you have in the business, for short-term assets and short-term liabilities. So things like inventory, your cash, making sure that we can meet our short-term obligations, but not having so much cash tied up in working capital that you could be getting better returns elsewhere. So these are the kinds of considerations for point 1 about optimal capital structure. And number 2 is managing the financial risks of the organization. So, have we got enough cash to pay our bills? Are we insolvent? Can we pay all our long-term liabilities? And so forth. So what are the objectives of Treasury? So there's a few key things that Treasury actually does on an everyday basis. So number 1 is Treasury management. So that's managing the flow of funds through the business. So that's to optimize profitability and increase the value of the organization within its risk appetite. Because you'd have some organizations with a low risk appetite and a high risk appetite. You might get higher growth with a higher risk appetite, but it also puts the business at risk. So it really depends on the organization, which leads on to our second point, which is around managing the risk appetite. So understanding and maintaining the amount of risk an organization will accept in order to achieve the desired level of return. So you don't want to put your business in too much risk. For example, you might put your funds in a very risky, investment vehicle, which offers high returns, but there's a high chance that it'll, go bankrupt in a downturn. And then let's say COVID-19 hits, and all of a sudden those investments are worthless. So, you've got a high return for your company, but if it wasn't within that risk appetite, then you're going to get your company in a lot of trouble. And the third and final point is efficient and effective treasury management. So just ensuring that all the cash surpluses are invested, making sure that all the money is actually working, because if your money's not invested, it means that you're not getting the interest or returns, and it's getting eroded by CPI. So every day that you have cash sitting around doing nothing, that cash is going down in real value. We also have to make sure that cash shortages are funded, that the interest rate and currency risks are managed, and that appropriate liquidity is maintained as well, so that we can actually pay our short-term liabilities that are popping up. So here are some of examples of those treasury functions, which fit into those objectives. So number 1 is acquiring optimum finance. So making sure that the company's actually got debt facilities in place at attractive rates, and you can fund all those expansions and whatever projects you need to do. Number 2 is managing interest risk rate, foreign exchange risk, and commodity risk. So you might be trading in Japan, and there might be a lot of fluctuations going on. So what hedging tools and other financial instruments have you put in place to make sure that the profitability of your business isn't negatively impacted? Number 3 is advising management on capital structure and managing the organization's liquid assets and working capital cash management. So again, making sure that management are aware of the risks and benefits of each of the different capital structures. So you might have a preference to have a certain level of debt in the business, so you can take advantage of those interest deductions. But making sure that management is aware of, different priorities of debt and equity repayment and all those little different things which we'll go through later on in this topic. Liaising with the organization's banks and credit agencies, so making sure you've got those contacts, etc. So you can always renegotiate credit, etc. Number 5 is investor relations. So if this is particularly important if you're a listed entity on the stock exchange. So investor relations is a key part of the job, because there'll be a number of questions coming back from investors. You've got to make sure that all management reports go out to them, financial reports go out to them. Dividend policy and disbursement. So ensuring that all dividends are regularly calculated and funds are actually paid out to shareholders as well as all communications to them, so they understand what's going on, so you don't have angry shareholders coming to you later on. So share repurchases as well. So often in an organization you'll have shares going in and out. Even if you're a private organization, you may want to buy back some of your minority shareholders, and that will involve calculating the value, communicating with shareholders, ensuring the funds go in and out to arrange for those changes in capital structure. And then finally, mergers and acquisition analysis. So you might have a transaction where you're buying out another business or a competitor and so forth. So you'll need a team to actually manage that process, from the communication to the due diligence, to the legals and so forth. So within the Treasury function, there's usually 2 types of structures. So number 1 is the cost structure, and number 2 is the profits center. So an organization will generally either structure the Treasury function as one or the other, not both. And basically what that means is whether the division is seen as a cost or whether it's actually going to make profit for the business. And how it will make profit is actually recharging across to a different business unit. So let's start off with that profit center first. So let's say the division has a maintenance cost of $10 million every year, and that's the division's labor, it's the division's outsourced costs, and a fixed cost like rent and utilities and so forth. So it's $10 million a year just so the business can maintain this function. So what that business can do is actually issue an invoice to the to the support office and say, here's our cost, and you can even add a little bit on top, so maybe plus 3%, which is our management fee. So that means the business is charging out 10 million plus 3%, so its net profit will be 0 plus whatever the difference of the management fee was, so the 3% on 10 million. So their net profit is actually going to be positive, and therefore there'd be a profit center. Now the opposite is if they didn't invoice out their costs, they'd be a cost structure, which is basically, it's a cost unit, so it just accumulates costs within the business period, and it will be a negative profit business unit of $10 million. So there's a few different advantages and disadvantages of each. So number 1 is the business units can charge market rates, and this might be important if they're offering it for internal and external people, so for the organization and maybe some external clients. So I knew a division which offered recruitment both to the company that owned it, but it also had an external function which made a little bit more money on the side. And by offering those market rates, it helped contribute to some actual operating profit, and it made it more realistic as well. Number 2 is a department could actually be more motivated to make a profit by managing that P&L regularly, and this could help contribute to the bottom line, which would benefit the organization. So the disadvantages of structuring it as a profit center is by measuring performance on profit, there's a temptation to speculate, which could risk exposure within the business. So for example, to manage the business's credit or FX risk or interest risk, they might invest in a riskier financial product, which might have a higher chance of going bankrupt, and therefore they're unnecessarily increasing the risk exposure of the company that owns this profit center. Number 2 is considerable management time may be spent adjudicating between treasury and business units in regard to charge outs. It's really just an internal thing. It doesn't add a lot of value, and if there's a dispute between the business units, then it could waste time in disputes. And potentially there's additional administrative costs from doing all that extra work. So there's a few different roles that the management accounting and Treasury functions play within an organization. There's 4 types. There's outsourced, centralized, decentralized, and a combination of the two. So number 1 is outsourced. So some organizations just hire an external firm to actually manage their treasury function, and the most common reason for that is it's the task involved in managing treasury is becoming increasingly complex, and not everyone in an organization, especially smaller organizations, have that skill set to be able to manage that, and not everyone's able to monitor financial markets 24 hours a day, whereas if you have a big outsourced treasury firm, they will have the resources and specialization to be able to do these kinds of things. So there's some benefits to centralized. So centralized is basically where it's part of the head office control. The next step under this process is determining the stakeholders. Understanding what their different objective is, what the information needs, and how we can best satisfy them. So the definition of a stakeholder, it can be an individual person, or it could be a group, or it could be an organization itself. And these are the people who have a stake in the outcome of a decision, because they can be affected by them. For example, shareholders will be affected by the profitability of the business. Government could be impacted by the environmental decisions of the company. It could be the suppliers and staff, creditors. It could be the internal personnel as well. So the managers, the CEO, the CFO. If they decide to outsource the finance division, obviously the CFO is going to be impacted by that. So a lot of different examples of that. And then, of course, we need to consider what's the most effective means of communicating with stakeholders. So that might be with financial reports, written reports, balanced scorecard reports. So that'll be like a traffic light system of red equals bad, yellow equals okay, / could be better, and green is great. And review of management reports as well. So the difference between management reports and financial reports is financial reports generally have to comply with accounting standards when they're presented, whereas management reports, they're tailored. They can be presented in any way you want because it's a custom report for management. So you don't need to follow accounting standards. So for example, you might only track one specific type of revenue, and you can do that on a cash or accruals basis because there's no rules around how you want to do it. It's just what you want in that report. And then determining the stakeholders continued on. So this is some examples of information required by different stakeholders, which is outlined in your CSG. So it might be strategic information, so to do with strategy. So an example of a key stakeholder who would need strategic information is the board of directors. So that level of detail. So strategic is generally very high level, and it's generally historic or it could be predictive. So it's information that helps inform the decision on making those really high level decisions. Like, for example, do we want to continue acquiring businesses? Do we want to, develop our own business internally? Should we go into a certain market? So that's strategy, that very high level direction. Now, there's operational information, which is a level down. For example, a product manager with responsibility for product sales volume. So it's a lot more detailed in nature. So for example, you might want to give a product manager, all the different types of products within his division, how that's been trading over a long historical period, at a very detailed level. Now, you wouldn't give that to the board of directors because it's just too much information for them. They want to focus on high level, whereas operations need to focus on detailed information because that actually helps them drive their specific role, which is generally more specialized than someone on the board of directors. And then monitoring and measuring performance is another one. So for example, a cost manager with responsibility for managing staff. So he needs to know how he's tracking. So what's his KPI? So whether that's the budget or against prior year. So he needs to know that information. And it's also important to be able to monitor changes. So let's say we implement a new system. It's important that we send management reports to the key stakeholders and saying, this is how we tracked before the change, this is how we tracked after the change. So this is often a key step that's neglected. We do a lot of analysis before implementing a change, but it's often forgotten to do the analysis after the change is implemented and actually see how that is tracking and whether that was the right decision. Then there's routine reporting, so it might be like a monthly P&L, it could be a weekly cash flow forecast to make sure we've got enough liquidity, or it could be ad hoc. So ad hoc just basically means any general reporting. Your manager might come to you and say, hey, I need this analysis on a specific report, or it might be looking at just a one-off unusual thing. That would fall under ad hoc reporting. So general strategies that organizations use is the third category. Strategy is an attempt to determine a long-term plan for success. We talked a little bit about it before, so it's very high level. For example, do we want to go into a particular new market or a new product line? So Porter, which is empirical work, and when I say empirical work, this is basically just a paper that's been put forward in this field of business. Dated 1996, he makes the claim that organizations mistake simple operational effectiveness for strategy, i.e. doing the same things as competitors, only better. So what that means is, strategy is thinking big picture, right? So it's, do we want to go into a new product line, new market, etc.? Are we doing the right thing? Whereas operational effectiveness is, let's do what we're currently doing, but let's do it as good as we can possibly do. Well, that's usually a good thing, but what happens if strategically you are doing the wrong thing? For example, you are operating in a market that might not exist in 3 years, and you're putting all this work in to be the best damn operator in that market, but it doesn't really matter if the market's not going to exist. So that's basically what he's talking about there. And strategic planning is, it's establishing the things that you need to do, or seeking a difference that can be preserved in order to ensure superior profitability and therefore long-term survival. So I used the example of, is that market even going to be around in some time? Well, yes, this is the key part here, long-term survival. So we might have superior profitability through this operational effectiveness, but if the market doesn't exist, then there's no long-term survival. So he also put forward this generic business problem-solving approach. So number one is define the destination. So where do we want to go? What's our strategic direction? So we want to, by 2025, we want to have, one product line in each market. We want to have a 20% market penetration. We might want to, so forth. Step 2 is environmental analysis. So you're looking at the internal and external environments. So external might be, government policy. Internal environment might be, the staff that we have on board, the investment capability, our financing, etc. Generate alternatives, strategic alternatives. So, maybe instead of investing in this, small market over here, what we could do is, we could double down on our other market, which is our cash cow, and really just drive that market instead. And the fourth one is select the best, implement and monitor. So consider all your strategies, including the alternatives that you've put forward. Consider the resources that you have, and consider how those are allocated, and then evaluate and control it and provide feedback. So I gave the example about, should we double down in our actual cash cow market, which is sustainable, rather than spending all this money on a new product or a new market which isn't going to exist. Let's get rid of that allocation, reallocate it to our profitable market. And then we just evaluate it, make sure that we track it over time, and see if our projections around the old market and the new market actually were consistent. Make sure we made our decision off the right data. Okay, so this is just going through each of those steps above in a little bit more detail. I don't think we particularly need to do it. I'll just go through some of the key parts. So vision is the direction of the organization. So strategic analysis, so looking at our environment. So a common way of doing that, which is just this part up here, a common way of identifying those two, internal and external, pros and cons, is using a SWOT analysis. So many of you are probably familiar with this already. So this is basically a 2x2 square, so 4 squares in total. And each of the letters in SWOT stands for something. So it's strengths and weaknesses, opportunities and threats. So strengths and weaknesses are basically, your internal, external factors which are currently affecting your business. So where are you good at? Where are you weak at? Which of these are internal? Which of these are external? And then opportunities are threats. So opportunities are like, what can we do next that we haven't already done? And threats are what are possible risks that aren't current but may arise in the future. And then continuing on this step 2, so another means of identifying this internal and external environment, we could do an internal analysis, so looking at the factors within the organization, for example, the structure, the culture, and the resources. And there's some frameworks that we can view this through. So number one is value chains, and number two is a resource-based view. So a value chain, what's a value chain? So again, this was proposed by the same guy, Porter, this concept. So in order to determine the strengths and areas of competitive advantage, an organization should analyze its generic value chain. So a supply chain is the steps from raw materials to finished goods, and a value chain separates steps into categories aligned with responsibilities, allowing an organization to assess the value out of each activity from the customer's perspective. For example, you might have a shipping part. Let's consider Woolworths, for example. So they'd have suppliers is where it starts off. So the farms out in the countryside. And then you might have a middleman who buys up all the products from the farmers and sells that to Woolworths. And then you might have a distribution center which buys all the products and then sends it out to each of the Woolworths stores. And then you might have a trucking company which manages all the fleet of trucks which deliver to your stores. And then you've got your branch of stores and a whole network of managing those. And then you've got your customer experience in there as well. So you've got self-service checkouts, you've got manned checkouts, and so forth. So it's looking at each of those parts and saying, okay, so where is the value add for each of these? We currently we outsource our trucking management facility. Maybe we could bring that in-house, and that's going to reduce our costs, which we can pass on to the consumer. Maybe we cut out the middleman and we actually start up buying all the farm products wholesale ourselves, and that's going to save us X amount of dollars. So it's really analyzing the total chain from start to finish of the business into different categories and seeing the cost and benefit of each and where's the opportunity lying. This is a great way of looking at your business internally. And we generally split up this value chain concept put forward by Porter into two categories. So number one is primary and number two is secondary. So primary tasks, these ones at the tops, are the key ones. They're the key function of the business. And these primary tasks are supported by secondary tasks. So consider it like primary is like the key operations of the business, and the secondary task is like the head office usually. So you might have a payroll function or an HR management in your support office, because to be able to do all these key steps you need to have staff, and then to manage those staff you need an HR department and so forth. So that's how we split it up to look at it as well. So key functions and then secondary functions. And then further, so still on the same step, still on internal and external analysis, we also use this resource-based view. So this concept was put forward empirically by a different author, this time Barney, 1991. And he believed that an organization is required to look internally at its own resources and compare these to its competitors' resources to see if it can provide a competitive advantage. So this has two steps. So number one is identify the resources, and he put forward three categories where you could allocate those to. And number two is to apply a series of tests to each resource to see whether or not it can form the basis of a competitive advantage. And the kind of characteristics that we're looking for in this test are which of these resources are valuable, which of them are rare, difficult to copy, not easily substituted. So the three categories that he put forward as part of this resource-based view is number one, tangible resources, number two, intangible resources, and number three, organizational capability. So tangible resources are physical objects. So for example, Apple has a lot of cash sitting around. It's got $1 trillion worth of cash sitting around, or just some huge amount of money. So, and same with Warren Buffett as well. So these firms are in a position to acquire, a new company, whether it's part of the value chain, whether it's a competitor, whether it's investing in a new plant, and so forth. So that's a competitive advantage that Apple has. And there's intangible resources, so non-physical assets. So mostly this is IP, so intellectual property, so brand image. It could be the employees itself, so it might have a really capable CEO or executive team, which are much better than a competitor, and they're going to lead our company to a better position. And then there's organizational capabilities. So processes that turn inputs into outputs in a superior way. For example, extremely fast product development, super efficient manufacturing, outstanding customer service. So you might look at Toyota versus Nissan. And Toyota, we all know, has this just-in-time methodology where they get their inventory in really quick. They've got amazing processes. They value quality over anything else. So you might argue that because of those processes that Toyota has a competitive advantage versus Nissan, which doesn't have those processes in place. So in 20 years' time, there's a higher chance that Toyota will be around, whereas Nissan will not be. Okay, so still on step 2, but instead of internal, let's look at external analysis. So the external environment are variables outside the organization, so it's usually not within control of senior management. So they can be broad forces and trends with the general economy, or they can be specifically within the industry that organization operates. So there are a few different frameworks that we can use to analyze the external economy. So the first one we're going to go through is the Pastel Analysis. Secondly, we're going to look at the Porter's 5 forces. Thirdly, we're going to look at the competitor analysis. And number 4, we're going to look at the risk analysis. So the first framework of analyzing the external drivers is the Pastel Analysis. So it's called the Pastel Analysis because each of these letters stands for a certain category. So political, economic, social, technological, environmental, and legal. So the purpose of this is to identify issues within these categories that could have an impact on the products it produces or intends to produce. So managers need to think about which of these factors are likely to change and which ones will have the greatest impact on the business. We also need to identify key factors in the general business environment and its own environment. So political, we're looking at trade regulations, taxation policy, and political stability. So we might be looking at grain farmers and thinking about what are the implications if China, our biggest customer, puts on tariffs, as they have recently done in response to Australian government looking into the COVID origins. You might have economic things. So what's likely to happen with interest rates? Are they likely to go up, which will have a big impact? Do we have exchange rates fluctuations? Should we be looking at hedging? Is our product demand linked to GDP and therefore we're exposed if our economy tanks? There's social, so population demographics. For example, we might be operating in Japan, which has an aging workforce, but we're targeting a younger demographic, so maybe that's the wrong geographic to be focusing our attention on. It could be technological, so innovation, new product development, and rate of technological obsolescence. So maybe our machinery, which is our current competitive advantage over competitors, maybe it's aging rapidly, and without R&D and investment in those technology, we might fall behind against our competitors. It might be environmental, so it could be global warming, environmental issues. It could be legal, so competition law, health and safety, employment law, and product regulations. So maybe you're working in childcare, which is a heavily regulated industry. And we should be constantly aware or even lobbying the government on certain, issues around regulation of childcare centres, which may improve our profitability. So the second framework that we're going to look at in terms of understanding external issues is the Porter's 5 forces. So what this framework does is it looks at the forces most relevant in determining strategic behavior. So some of the key things it does is evaluate competitors, customers, suppliers, and labor supply within the industry in which the organization works. So these are the 5 forces here, and we'll go into detail about what each of these mean. So bargaining power of suppliers. So this is, for Woolworths, it could be the farmers who provide those goods. We've got the threat of new entrants. So for example, it might be Aldi coming in or a new German supermarket coming into a market. So how easy it is for them to come in and enter and disrupt your oligopoly or monopoly on the market. We've got the bargaining power of buyers. So for example, your customers who come into your shops, or perhaps from the farmer's perspective, it's Woolworths and they've got a lot of bargaining power right now because there's only so few competitors in that market. It could be the threat of substitute products or services. So you might be Intel, for example, and you're creating you've got a high market capture of graphics cards, but then someone like AMD comes along and they've got a similar product which is cheaper and does the same job or even better, and a lot of market share is quickly being eroded because of that. And then you've got rivalry, the fifth one. The middle one is rivalry among existing organizations, so industry competitors. So you might have Coles lowering its prices relative to Woolworths, which might chip away at Woolworths' market concentration, and so forth. So let's go into a little bit more detail into each of these. So first of all, the top one, the suppliers, bargaining power of suppliers. So some of the sources of power for suppliers are switching costs. So, for example, if Woolworths were to switch to a different supplier, it's going to cost a lot of money to set up those new relationships, those new systems, those upfront fees, any rebates to renegotiate. So there is some cost. Differentiation of inputs, so different inputs, supplier concentration. So they might make up a large percentage of that market. Presence of a substitute, importance of volume to supplier, impact of inputs on cost or differentiation, threat of forward/backward integration, cost of relative total purchase in industry, relative size. So I probably won't list all of these points. I think I'll just explain what each of them are in general. So threat of new entrants. I gave the example of Woolworths. What's the risk of a new German supermarket competitor? As was the case when Aldi came into Australia a few years ago. And then there was another competitor trying to come in, and Costco came in as well. So it's really, economies of scale. How big is Australia? Is it worth it for those competitors? How important is brand in the equation? How much capital is actually required? Because you might have equipment that costs billions and billions of dollars. It's actually going to create quite a large barrier to entry. But if you're just setting up a few shops, it's probably not a large barrier to entry. Product differences. So you've got those Aldi products that Aldi sells versus the product brands that Coles sells. So what's different there? Again, switching costs. How long is it going to take to learn the market, to come in and have that new learning curve? Access to inputs, low cost product design, government policy and restrictions, and expected retaliation. So you might actually have Woolworths turning into a cost cutting business, or might even sell their products to become a loss leader, so losing money on all the products they sell just for long enough to make the competitor go bankrupt, and then after that they can increase their prices. These are all facts to consider, as how high is the threat and the barrier of entry for new entrants. So rivalry, the middle one, between existing organizations. So how fast is the industry growing? What's the concentration look like? If Coles has 90% of the market and Woolworths has 10%, then obviously Coles, it's possible for them to push out Woolworths by offering lower prices and so forth. Differences in product, brand identity, the switching cost for the consumer, informational complexity, diversity of competitors, so actually how different they are. So Coles and Woolworths, I think, are pretty similar. So customers could easily switch between the two just based on, say, price, for example. Exit barriers, discounting. And then what else have we got? So we've got bargaining power of buyers. So buyers can actually, band together and negotiate lower prices. How concentrated is that buyer market? How large is the volume as well? Because if it's a small market, then they probably don't have a lot of buying power. Switching costs is the same for all of these. Buyer profits, price sensitivity, and so forth. And then finally, threat of substitute products or services. So that's the risk that I gave the example of AMD and Intel. So AMD's come along with a product which does the same job, if not better, for a lot cheaper, and buyers are switching to it for it as a result. And then, of course, there's a SWOT analysis, which we talked about. So just to summarize all of the frameworks that we have available, so categorizing between internal and external analysis. So SWOT covers both of them. SWOT's got internal and it's got external. For internal, we've just got the value chains and the resource-based view. And for external analysis, we've got the Pastel, Porter's Fire Forces, competitor analysis, and risk analysis. And each of these just feed into the SWOT analysis, so the strengths, weaknesses, opportunities, and threats. So actually listing each of them out one by one and seeing where most of it lies. So going back to step 3, so after we understand our internal and external environment, we need to generate strategic alternatives according to Porter. So the strategy formulation definition is the development of long-term plans for the effective management of environmental opportunities and threats in light of corporate strengths and weaknesses. So basically just matching up all the strengths and weaknesses that you identified previously and figuring out what's the best plan to achieve a sustainable competitive advantage over our competitors, which means it'll be difficult for our competitors to basically copy our approach. And then the 4th step is just to select and implement the best of those strategies. So there's generally 3 types of strategy. There's corporate strategy, business strategy, functional strategy. So corporate strategy deals with the industry or markets an organization seeks to compete in. So what which market should we go into? Which market should we leave? Business strategy. So that's how an organization competes in a single market or industry. So it's relevant for a single business unit or product competing in a single industry. So, how's our approach of getting it out there? What's our approach of, distributing and so forth? And then functional strategy deals with specific management functions. So you might be looking at, one division in your organization. Should we outsource our accounting team? Should we invest in our production team? Should we, cut our marketing team? And specifically around allocation of resources within those departments. There's also corporate level strategy. So these are just generic options for growth. So it could just be, do we grow via acquisition or do we grow organically? It could be diversification. So, should we go into a different product or market? Mergers and acquisitions. So acquisitions are basically when you, acquire another business, and merger is when you basically 2 similar sized organizations, you kind of merge them together and you operate as one combined entity rather than the subsidiary just tucking in. There's vertical integration, so you might want to acquire a supplier. So, for example, Tesla is investing very heavily in battery technology because they know that they're going to get a competitive advantage. So what they did is very early on they bought up all the best battery suppliers, and there's actually quite a large shortage of battery supply in the world, especially considering how much you're going to need to supply a mass market of electric cars. And the large manufacturers now, such as Daimler and BMW, etc., who are now getting on the trend of electric cars, are realizing that they actually don't have access to a lot of battery producers and the latest technology as well. And Tesla, they've actually now got basically a monopoly on the battery market. They've got the best tech. They got majority of the suppliers signed up exclusively, and now they're starting to invest in their own battery factories as well. So this vertical integration is a great example of what Tesla's done, and it's been a really, really helpful and a great strategy to diversify from their competitors. Okay, and then going to step 4. So which strategy do we actually choose? How do we actually allocate resources? How do we evaluate that and give feedback on the best strategy? Okay. So we should be considering each of the 3 strategies that we discussed above, so corporate, business, and financial strategy. So let's focus on corporate strategy first of all. So this is a focus on attempts by corporate level managers and directors to raise the performance of business units within the organization. So it decides, which business units are in the portfolio at any point in time and how the parent contributes to the sustainable improvement of the operating performance of those business units. Now there's a few ways we can do that, so generic options for growth through acquisition and so forth. Next, so this is just a recap. And then the next strategy is business level strategy, which is this one here. So which is focusing on, how an organization competes in a particular market. So one of the key things is we need to focus on what's the core competency. What does that organization do well? And where does that strategic value lie? And how can we use that competitive advantage sustainably and use those core competencies to achieve that. So one of the frameworks that we can use to review business level strategy is again from Porter, which is Porter's generic strategies. And he hypothesized that in order to create competitive advantage in a particular industry, an organization needs to adopt one of three generic strategies. So number one is cost leadership, number two is differentiation, and number three is focus or niche. So cost leadership is basically, having the most attractive price in a market. Number two is having a very different product. And number three is having a focus or a niche market. So let's think of some examples for each of these. So for cost leadership, let's use the example of Costco, because Costco wants to differentiate from its competitors by being the cheapest in all of its products. So it's going to allow you to buy in bulk to achieve that, and it's going to have large wholesale deals to get the cheapest product out. And that's why people go to Costco, is to save as much money as possible. So number two, an example of differentiation could be Apple. So, back in the day, Microsoft and IBM had a monopoly on the personal computer market. When Apple came along, they were selling a personal computer. It was still a PC at the end of the day. But what they were selling was something completely different. It had amazing design. All the marketing was on point. They had their own operating system, which was completely different to Microsoft. And it was all designed in their own way, and they had their own systems for everything. And people bought them because they were buying an Apple, not because they were buying a personal computer. If they wanted a PC, then they might just want the cheapest one from Microsoft or IBM. But if you're buying an Apple, you don't really care about the price because you just want to buy an Apple because it's different. It looks good. And the third and final one is a focus or niche. So this is basically a small area in the market which is not being filled. So you don't have to compete on cost, and you don't have to compete on differentiation. So examples of a niche market that you might enter into is, for example, making your products vegan or dairy free to cater to a particular part of the market, which want cruelty free products and so forth. There's numerous examples that you could extract for this, but it's generally a small market which isn't heavily saturated, but generally has a lower market concentration. Mm-hmm. So to summarize those three broad categories into 5 specific strategies which fit in within those broader strategies. So number one is broad low cost provider. So this is someone who sells to as many people as possible but at a very low cost. So for example, Costco. There's broad differentiation provider. So this is offering point of difference around products or service that appeals to a broad spectrum. So for example, Apple would fit into this category. There's best cost provider. So this is providing excellent value to customers by offering high quality goods or services at a lower cost profile than its rivals. So it's very important that you understand the difference between this one here and this one here. So this doesn't necessarily mean that you're offering the cheapest products, okay? Because there could be, a cheaper Chinese made product, but it only lasts a year. So you could be making a product which is, reasonably cheap. So maybe it's mid-range, but it's going to last you 10 years. So overall, your value proposition per year is still better than your other competitor, So it could be something like a Seiko watch. So there's something cheaper than Seiko, but Seiko is good quality. It's going to last a long time. It's still pretty cheap, but it's not like the cheapest thing on the market. So, but I think it's got one of the best value propositions on the market for watches. You could be a focused strategy brand on low cost. So this is still around cost, so trying to achieve a lower cost profile than rivals. But it's focused on delivery to a small band of customers, so it's a smaller market and lower cost. So it's not trying to get as many people as possible. It's almost a niche market, but trying to get a low cost. And then there's focused strategy based on differentiation. So again, a small niche market, but a point of difference. So for example, there's a new market for lab-grown meat. and there's a few different providers working on it. There's one called Beyond Meat, and there's a few other low-cost providers. So the ones that are cheapest would be the focus strategy based on low cost, and the one that's trying to provide maybe the best product, or the one closest to meat, to real meat, would be based on differentiation. Focus strategy based on differentiation. So these can be summarized in this diagram below. So it's a 2x2 square, and the x-axis is the type of competitive advantage being pursued. So it can either be lower cost and differentiation, and then on market size, it's either a narrow market or a broader one. So this one up here would be a broad market, low cost. This one down here would be a narrow market, focused on differentiation. And then ultimately the one in the middle is just possibly the best target, which is just best value proposition, regardless of being lowest price or anything. It's just what's the best value proposition to the customer. So to summarize, these types into a table, a worded table. So focusing on cost, so getting the cheapest one. So for example, these two strategies here, overall low cost and focused low cost, the way you can achieve that is through high asset utilization rates. So spreading fixed costs over more activity. So, economies of scale, the more you produce, the less it'll cost per item. For example, Costco, ordering as much as possible. Standardizing products, so using the same components in multiple products. That's what's happening with car companies these days, is they're trying to just share parts between as many companies as possible, which brings down the cost. So automating it, so using robots instead of labor. Efficient supply chain, so buying in bulk, negotiating prices, controlling overhead costs. So basically just getting your own costs down. And then differentiation, which is these two strategies here. It's delivering a high quality product or service. Really strong sales and marketing. So this is what Apple is really good at when they in their differentiation. Research, development, innovation. So you might have a new product on the market because you've put money in R&D. And it's most successful when customers are not price sensitive, i.e. because you generally pay a little bit more for a differentiation strategy than a low cost. So it should be you should focus on a market where customers are not price sensitive. Most successful when it's not a highly competitive or saturated market, when there's no underservice of customer segments and organization with unique resources, talents, or knowledge. So for example, Apple had Steve Jobs. And then the focus strategy, which relates to these two at the bottom, which is, finding a market niche. Instead of being a broad market provider, so as many customers as possible, it's focusing on a smaller market and targeting them. So it's a way of gaining competitive advantage by really customizing its product to meet the specific needs of a small target market. So if you're trying to sell to everyone, everyone's got slightly different needs and stuff like that. So if you do want to sell to everyone, your products are going to be relatively generic, and they might not solve all of the customers' problems or needs or wants. So this is the benefit of focusing on a certain market, is you can increase demand by really targeting and tailoring your product to meet that demand. So some other elements to consider is the size of it. It must be big enough to actually make enough revenue for the company. Can't be a market size of like 3 people. Must have a decent size for us to make some profit. And is the organization actually capable of providing the specialized products? Because it's going to take some time. So it's just some general points to get of learning to get to that optimal point, which is in between all of them, which is that best cost provider strategy, best value proposition, basically. Number one, you should really only pursue one strategy. So don't try and pursue all 4. Just choose one of them, because you start getting confused, and it's going to create problems. So you put yourself at risk of being caught between competing strategies and not achieving any of them. But you can, however, create different business units or brands that pursue different strategies. For example, Toyota is trying to have that mass market low cost, whereas Lexus is more of a smaller market, the luxury market, but differentiating. So making, super high quality premium cars that are reliable. So another point raised by Porter empirically is understanding strategies in the context of your industry's life cycle. So each industry is not static. Think of it as living in an ecosystem. And strategies that might work today might not work in the future. So strategies need to be constantly monitored and changed as market conditions changes. So industries are in different life cycles, right? It could be a new industry, or it could have been existing for hundreds of years, and it's really a stable, a very predictable, not a lot of growth left in it. So these have just been empirically defined as either in the introduction phase of a life cycle, growth, maturity, or decline. The introduction is obviously the newest one. So for example, a high-tech industry that's just come out. And decline is something that's been around for a very long time and is slowly evaporating. So for example, the mail service, Nokia was another example as a company rather than the industry itself. So each of these can be defined by several KPIs. So appropriate generic strategy. So, you shouldn't be trying to achieve a low-cost strategy in a new market. What you should be doing is trying to differentiate and have the best product. Whereas for a declining market, cost leadership is probably the best one. Market growth is low for introduction, very high for growth, low to moderate for maturity, and negative for decline. Number of segments, very few, some, many, few. Intensity of competition is low in the introduction because a lot of new companies haven't really entered the market yet. Growth, it's increasing as people start pouring in. Maturity is very intense because it's been around for a long time. Decline is changing because some of those competitors might go bankrupt and leave the market. Emphasis on product design is very high in the introduction phase, and it slowly phases down to low in the declining phase. Emphasis on process design, which is intricately linked with trying to bring down costs and so forth. It's low in introduction, getting all the way up to high in maturity, and then low in decline. The reason it's low in decline is same reason that a lot of manufacturers might be going out of business, is that we don't want to invest too much strategically in refining our processes in industry that might not be around very long. So in a mature industry, it makes sense because we expect it to be around a long time. But if it's in decline, well, probably time to look at the next industry and reallocate our resources into planning our next move. Major or function area of concern should be R&D for introduction, sales and marketing for growth, production for maturity, and then general management and finance for decline. And then overall objective for introduction is to raise market awareness, create consumer demand and growth, defend market share and maturity, and then consolidate, maintain, harvest, or exit in decline. Okay, now we're going to revisit this. So back to the types of strategy in terms of selecting and implementing the best strategic alternative. So we're going to focus on functional strategies now. So this is to do with specific management functions, for example, production, marketing, or accounting. So these are business unit strategies. It's dictated by the parent's corporate strategy. To be successful, it should be built around distinctive competency embedded within the functional area. So the financial performance of a business unit is determined by the joint impact of several effects. So the corporate effect, so parenting, parent company advantages, business unit effect, how good's the local management, the industry effect, so result of the life cycle of the industry, the year effect, so the macroeconomic cycles, the industry effect. So some industries have upturns and downturns in specific years, and then other. Okay, so now we're on to the last part of this chapter, which is just around reviewing, controlling, and providing feedback to strategies that have been implemented. And the reason is we need to actually track whether it was the right decision and whether the data and forecasts we were working off were correct as well. So control is a step which step managers must make to ensure that organizational strategies are implemented or modified. So the monitoring or effectiveness of actions and plans and taking remedial actions to correct deficiencies. So it's a major part of the control function. Without adequate control systems, employees may not act appropriately or in the organization's interests. So control is the policies, procedures, measures, and systems that an organization uses to prescribe and measure performance and to monitor achievement of organization's goals, objectives, and strategies. So there's 5 stages in establishing and maintaining organizational control, applied all to operational segments. So number 1 is planning, so it's setting out your goals and objectives. Number 2 is executing, which is led by senior management, which is the coordination, communication, implementation of strategy. Stage 3 is monitoring. So making sure that the current performance is measured against the standard or budget measures established in planning. Number 4 is evaluating. So, looking at actual versus budget and interpreting and evaluating that. And then 5 is correcting. So taking corrective actions to ensure any circumstances that have led to failure of objectives. For example, we may have thought that our product line is declining, so let's invest in a new product line. So we've spent all this money with the assumption that our new product line is going to grow 10% year on year annualized. Now, a year later, we look at the budget, and we find out that the actual revenue is much lower than the forecast revenue. So our return on our investment in this new product line is much lower. So what we'll do is we'll look at the controls that resulted in this, and because we've made this evaluation that we haven't met our targets, and we'll find out that the management was incentivized to keep costs based off their P&L, and this helped influence their decision, and then corrective actions were taken by changing the terms of the bonus so that this wouldn't happen again. So there's some ways that we can help increase the level of control in a business around these investment decisions and strategic decisions. So number 1 is responsibility center. So this is a business unit or a division in an organization, and this division is responsible for the activities and results of the organization. An organizational unit can be considered a responsibility unit if it has its own objectives that guides its activities, and a manager that has been delegated authority and autonomy to make decisions on the resources required to achieve the unit's objectives. So there's a number of ethical issues around this, and behaving in an ethical way is interpretive. Okay, so it's not one clear rule, and what ethics are and what is the right thing to do, it can be interpreted in different ways by different people, which makes it difficult to manage. However, the consequences of unethical behavior and the resulting decisions may directly affect the success, failure, or reputation of an organization. So it's very important that organizations manage this, and that there are protocols put in place to prevent this. So there is actually an ethical standards board, which the accounting profession is regulated by. And this does come up in exams, so it's important to be across, these boards and some of the frameworks within this, which we'll talk about a little bit later. And obviously, we understand the consequences of unethical behavior, so loss of confidence by, management, employees, or investors, declining company value. So, for example, the Australian Wheat Board declined their share price materially after it was made public that it had been making payments to the Iraqi government to facilitate the sale of Australian wheats despite UN sanctions. And then finally, company failure. So unethical practices may lead to the downfall of the business, such as Lehman Brothers during the GFC, or the downfall of a government even, such as in Iceland during the GFC. So these are the key 5 fundamental principles, and I recommend that you do learn these because they do come up in exam questions. So number 1 is integrity. So understand the difference between each of them and remember what they are. So number 1 is integrity, so to be straightforward and honest in all professional and business relationships. Number 2 is objectivity, so do not allow bias, conflict of interest, or undue influence of others to override professional or business judgments. So, you might have, a share scheme, and you want the value of those shares to increase. And that may influence your decision making in the business, which may put the business at more risk. For example, investing in a risky investment because you think that your share value might go up. Professional competence and due care. So make sure that you have enough professional knowledge and skill. If you're the CFO, make sure you've got all the required accounting degrees. Make sure you keep your knowledge up to date. Make sure that you are aware of new developments in law and practice and legislation techniques and act diligently. Confidentiality. So to respect the confidentiality of information. So if you're working on a transaction and you're working with sensitive information, make sure you keep that to yourself. Don't share that with anyone unless there's a legal right to do that. And finally, professional behaviors. To comply with relevant laws and regulations and avoid any action that discredits the profession. So don't break any laws, basically. Don't do anything illegal, and so forth. So that is the end of the chapter 1 for management accounting. Very long. Let's